unpacked seemingly like just immense topics to the point where it's hard to even know where to begin. Instead of trying to cover all of the bases and describe every angle of kind of these big touch points or complexities in the nature market space and beyond, we've taken the approach of bringing in folks that have a particular like experience and expertise to bring different voices to bear in a conversation that can often feel, at least on the kind of supply side, can often feel one-sided and more like an echo chamber. The last session last month was around verification, and we had a renowned scientist and verifier come and join and share his experience just over decades of seeing trends and seeing different innovations and what's working, what's not working. So we want to bring that same energy and dialogue into a conversation today around financing biodiversity credits. So another just kind of monster topic, impossible to cover every piece of it. But if we could give, this time, this hour and a half, to thinking through with the help of Inflow, of Constance here, who's joining us today, really an angle into the investment side, thinking of biodiversity credits as an asset class, really unlocking a fuller demand potential around biodiversity crediting. So I'm super grateful to Constance and the Inflow team for joining. For today, before we jump in and let them share about their work and experience, I'd like to just start with kind of a big picture, just kind of the why around all of this work and effort and dialogue to begin with. And what we're ultimately talking about is within the biodiversity credit space is a market response to a growing recognition that we have such significant biodiversity loss that will ultimately affect that whole ecosystems and humanity as we know it. So this is, in many ways, I see it as a blunt instrument that we can refine over time, but sitting with for a moment the ultimate purpose of biodiversity crediting. And I am a historian by nature, so I really like to start out any exercise with just how we got to this point in time. Um, and and as many of us know here, like the carbon market has been in existence for a lot longer than the quite nascent biodiversity credit market. And a lot of the initial kind of the dialogue and efforts around it were centering around financial flows for global conservation efforts. The different, I would say, like kind of clustering and momentum building has taken place starting in 2021 around the TNFD, the Task Force for Nature-Related Financial Disclosures. And then a lot was set in terms of tone with the Kunming-Montreal Global Biodiversity Framework in 2022, around the same time with different Paris Agreement articles. And then from there, we have a continued kind of momentum building and starting to see a lot of different methodologies and approaches emerge, an effort to kind of like reach for different standards and how to map on or not map on to the carbon market. So we get to this moment now where we have a lot of different folks that are spinning up within the biodiversity credit space. Quite a few of these we work with. The proliferation of methodologies and startups points to, I think, two sides of the same sword, which is one is it's great to see so much excitement and momentum and eagerness to build and engage. And at the same time, it creates a lot of confusion. And it can be challenging to parse whether you're on the supply side or the demand side, how to engage with the market. And At this moment in time, this is kind of the biodiversity market sales to date, and this is from Bloom Labs, which highly recommend as a resource for digging more into biodiversity crediting. The market to date has largely been a B2B sales demand kind of picture. The growth, we see a lot of different numbers tossed around, but one is upwards of 40 billion in biodiversity credit market by 2032. The drivers for that growth, you could probably think of many just right off the top. We've got corporate ESG commitments. We've got a lot of technological advancements, some of which, Regen is very much working on around blockchain and transparency and AI integration. You also have like expanding ecosystem scopes, looking not just at terrestrial ecosystems, but marine and coastal ecosystems as well. And then the last is this kind of exploration around the carbon market, how to bundle or integrate with that existing market. But it is, by all measures, set to grow. And at the same time, this growth bubble that we have in the supply side, there's still continues to be a lack of clarity around where the demand signals are. This was shared, something that I found among existing kind of biodiversity credit investors, but there still seems to be a lot of confusion and like early relationship building around that demand space, which is so much of what we get to dig into today with Constance and the Inflow team. The challenges are many to making this biodiversity credit space functional for obviously the supply side and those folks on the ground that are trying to steward and protect and restore ecosystems for the sake of all of the living things there, as well as for the demand side that's trying to engage, whether from a marketing perspective or from an offsetting perspective, trying to engage with kind of feels like a slippery market. Among these challenges, some of the others, that we have experienced is certainly a mixed market success, challenges around liquidity and scale. There's a lot of talk around standardization, and then also knowing that biodiversity is not the same as carbon. So how does one standardize within that kind of space? And then governance and inclusivity, when we're talking about a lot of communities, grassroots communities on the ground, indigenous communities on the ground, and ensuring that the system doesn't fail them, that it rewards and funds those efforts. So I want to end with just kind of where we are at Regen within the biodiversity crediting space. We're working kind of on three lanes with different methodologies, one of which was developed by ERA Brazil. And that one is the center panel. It's a Jaguar stewardship methodology and credits. We're working with a federation of indigenous communities in the Ecuadorian Amazon on an ancestral stewardship Jaguar credits. And then working with Terrazos based out of Colombia on habitat bank projects. And the challenges that I cited have definitely been felt across the board with each of these, and we can dig into those later during more dialogue and breakout. But for now, I would love to introduce Inflow. Constance joined a few eco credit builder labs back and was immediately just such an engaging presence and had a lot of insight and great questions. And so it became clear, at least with Austin and I talking about how much we wanted to bring her experience and insights to bear within this space. So Inflow is an independent practitioner-led advisory, and they focus on debt capital within the sustainable regenerative impact investment space. And I think just a great thought partner in we can do all the work beautifully to build these biodiversity credits, but how to build them out as an asset class and position them is something that still is desiring a lot of thought and work. So I will pause there and we can flip the script and give Constance the floor. Oh, I think you're still muted.
Yeah, sorry. It's great to be here. Thank you very much for having me and a couple of people on the call today. So let me bring up a little presentation that I prepared for today. Here we go. So yes, thank you. So Inflow, yes, is a small impact investment advisory. We're very much focused on mobilizing debt capital markets for climate action and a just transition. So my anchor client is involved in gender lens and climate, and I do some work on biodiversity. I'm interested also in the peace building process. So we have different pillars, but certainly biodiversity is something that I feel very inspired, particularly attending those Regen, which I came to the Regen Network webinar through my initial introduction to the Capital Institute and studying for investing for regenerative economy. So, so that's John Fullerton, credit to him. So what my first impression when I attended the Ecolab Builder sessions is that, yes, there was a lot of talk on the one side about the methodology, and I thought this is fantastic. These guys are talking about verifying credits and putting out some high integrity potential financial instruments that could be incredibly useful for very various types of stakeholders across the market. So today we wanted to talk about what it might look like to start unlocking the demand potential for biodiversity credits. But at Inflow, we also like to take a step back and look at integral emergence, coherence. Angela Fredanger is here on the call. She's the founder of WeCohere. And we like to think about these things as trying to break silos and really engaging with people who essentially, you know, belong to different worlds and breaking barriers so that we start speaking the same languages, we start understanding one another a little bit better. We come from different perspective, we use different languages. So I'm trying to think of this session as something as it, well, you know, so this is how I would think about the potential, the predicament, what's available, what could be, and the potential for it. My background is in fixed income investments, so both in sovereign, so rates and credit. But throughout my career, I've seen and observed a number of occurrences where new asset classes came to market, and what it's taken, what needed to fall into place for those asset classes, those emerging asset classes to actually come to fruition. So my big reference point when I think of biodiversity credits, the closest is the success that the green bonds market is experiencing. And when I see the public voluntary sales number that you were showing earlier at $5 million, I think that's really interesting because that's probably, you know, a nascent green bonds market. If you cast your mind back to 2007 when the first green bond was issued, and there's debate whether it's the World Bank or the European Investment Bank. But essentially, you know, this has now grown to a market that's $6 trillion. So, and that's all encompassing labeled debt of green, social, sustainable, sustainability linked debt. So from my perspective, the reason why I you know, I want to lean into this is that I'm like, well, it's a no-brainer in the same way that an investor in bonds would take outright exposure into a credit or a government bond, there's the next thing that happens is them using derivatives. And I know, they have a bad rap because of everything that's happened in 2008. But that said, imagine a bond investor using a bond future or an interest rate swap to manage their interest rate exposure. That would be exactly the same thing in my mind, that an investor might have an exposure to a particular industry sector, but they may want to manage the exposure to their overall portfolio level emission, and they would do that by using instruments that are essentially synthetic. They become an exposure that you take and you modulate in order to remain on that trajectory to net zero. Now, okay, so is it a coincidence that you picked the same quote as, or I picked the same quote as you, or you picked the same quote as me, Becca?
Oh, I think we should hear it plenty. So just keep it coming.
So, I mean, all I was going to say about this is I don't need to expand too much on the problem validator. If you're in this room, you're well aware that this is about our survival. So Becca and I selected exactly the same quote. We clearly have the same sources. So today I wanted to recap. So we're working on the premise that high integrity biodiversity credits on the blockchain technology as the potential of enabling robust transitions that are inclusive of all. And I think that's really important. The transition has to happen, but we need to think about taking the people with us and, be mindful of, it's the do no harm criteria, it's planet and people. And so today we are exploring how we could position those instruments as an emerging asset class for both regenerative finance from a corporate perspective and investment solutions to investors. And that would need to be suited to the needs of the land stewards, first of all, the corporates and investors. So on this, struggling with, sorry, I don't know why I can't. So looking at this value proposition, we are essentially trying to triangulate this return preservation, because we know that stranded assets, for example, can be an issue and can start hampering the performance of some corporates and some investors in their portfolio, risk mitigation, and adaptive socio-environmental impact. So we have those three groups of farmers, local communities, indigenous partners, trying to find a compromise with the corporates who are engaging fully in a transition to net zero, and those investors who have taken the view that they wanted to invest responsibly. So in my opinion, the high integrity, and when I say, every time I say high integrity, is because it's almost making the assumption that a credit, biodiversity credit coming out of a platform such as the Regen registry solution would obviously have been validated and met certain criteria. That means that we are creating a market that is credible. So first, you would be able to reward farmers, LCs and IPs, excuse me, I also have a little bit of a cold, for delivering positive externalities from nature-based solutions. And the whole point of this is to engender this virtuous regenerative cycle. We would at the same time support corporates that are willing and able to take their corporate balance sheets through a transition to net zero emission by 2030. And that would mean meet entity level assessments, achieve their targets, and therefore access borrowing to finance that transition. And then finally, the third group, responsible investors, would be able to offset their residual investment portfolio level emissions and innovate towards the de-risking of ROI. We know, by the way, that return on investment is going to be increasingly threatened. And that's why we're starting to see some issues bubbling up in the insurance industry. And all that in the spirit of reducing risks in sustainable projects that can enhance their attractiveness of the attractiveness of high impact projects. And again, really you come full circle with that that virtuous cycle that we're trying to create. So you want to do this credibly and at scale, but there are credibility and scale are not enough. From an investor's perspective, there are going to be 5 hallmarks that you really want to meet, and this is not exhaustive. I'm sure there are other criteria, but if we are to really create this really tight model of, okay, what is you trying to achieve? You want it to be credible, you want it to be scalable, you want the market to have some depth of liquidity, you want it to be cheap to implement and execute, and you want those credits to be usable, as in available in the market in different forms. So the must-haves, absolutely must-have when a new asset class, a new financial instrument comes to market, is that there are some global standards that are fully harmonized and universally accepted and fit into those frameworks that are well recognized. So, for example, if a green bonds come to market, there are some terms dictated by ICMA, or the ICMA, which is essentially the capital markets association. So it's International Capital Markets Associations. It's setting the criteria from top down, so creating an investment universe that is lofty enough, diverse enough for investors to dig in and really have the different levels of risk return that they need, because they need that high level of diversification within their portfolio. So you need the universe to be super broad. And then you'd have someone like the Climate Bonds Initiative, an NGO that created a taxonomy that is more bottom up. So you set criteria per sector. In your case, it would be a different sector for, so land, soil, water. It could be different. These could be the sectors, and you could diversify your credits to the max. The second thing that I was thinking is that probably, eligibility to offset all sorts of house gas emissions. So I was thinking, scope 1, 2, 3. So 1 to any emission out of your business or created over the course of carrying out business, but also 3 from your supply chain. And then traceability and verification, which, as I mentioned, you would hope happens at source, or that process starts at source and can be validated through the Regen registry solutions. And also what's appealing in my mind is this idea of putting all this on a blockchain in order to aggregate to an investable size. And the reason why I say that is that, for example, I work with a lot of grassroots projects in Asia, in emerging markets, and often we work with MFIs, because if we work with individual project developers on the ground, it would be really too time consuming, and there needs to be a level of aggregation of projects at some point in order for placement agents, like some banks would step in as placement agents to find investors, but it needs to come to a size that will fit in a very large pension fund portfolio, for example, or even just a private investor who has maybe in the tens of millions and not the 50,000. So that's the aggregation dilemma. The nice to haves is, of course, certification, which usually comes because it's additional assurance, and it's based on the ISO standards. It usually comes at a cost, but it gives this additional level of assurance, and often with it comes an additional, verification later down the line with, we call it, at least at IX, we call it the last mile impact verification, just to make sure that the original stakeholders are seeing the impact that the aimed for when they started the project. So, and then listing on stock exchange can be really useful. And I know now I'm looking at, this becomes really aspirational, but not so much. I mean, the London Stock Exchange has been thinking about these things, and I've shared with David Fodson some information on what the London Stock Exchange has created in terms of the VCM markets. And I appreciate that carbon markets are not the same as biodiversity credits, but that said, I would imagine that it would be probably processed through the same kind of platforms and the same frameworks. And then finally, again, this is aspirational, but you would want probably to have such a broad universe that you can start populate indices, so that as far as investors are concerned, it's even easier to pick up. And that goes to the usability point, both the stock exchange listing for secondary market trading. And by this, I mean that, if you just issue the credit and you can't sell it on, that really loses quite a bit of appeal from an investor's perspective. So that's one aspect of the usability, and the other aspect is those indices. So biodiversity credit benchmarks can become a thing, and it would be, taking the form of like an ETF or an iShares or Vanguard or these kind of. And I know all these sounds like terrifying, but this is where you're able to sort of scaling, which takes us to something that I talk about it a lot in the work that I do at Inflow. It's about activating this entire sustainable investment value chain. And I thought I'd bring it in here because I think sometimes, and I'm assuming, there aren't many finance people on this particular call, that sometimes finance is seen as this big block, and people think about banks a lot, and it's actually a very diverse ecosystem of its own, and everybody's has different is looking for different things and looking to deliver on different imperatives. So I've adapted my good old sustainability investment value chain to incorporate nature capital, which would really come first. But I want you to think of this as really a loop, because there's going to be a level of engagement and stewardship on both sides. So, we need to keep creating those good feedbacks so that we can work together on solutions and incorporate and improve over time. And, it won't be overnight, but and there will be crisis and allegations of greenwashing. But, we need to keep on working together and make the process very much, much more robust than we have seen so far. So yes, if you start with nature capital, obviously the next thing in chain, your biodiversity credit can be used by corporates, and we're going to talk a little bit more about that in a minute. The next thing that happens is, in order to push the biodiversity credit down the value chain, would be potentially, but that's optional, to have a concessionary funder coming into play and supporting, either by way of de-risking by taking some of the risk and underwrite some of the risk of those instruments, or supporting a program or campaigning for creating better frameworks. So it could be different ways, but certainly concessionary funders sometimes come at in a lower tranche, at least in a bond structure, they would come in at a lower tranche with potentially higher risk, but a lower price, and to enable for the senior tranche of a bond to be scaled. So then obviously key stakeholders to engage with are the banks, and they can be placement agents, as I mentioned. They can be lenders, underwriters. Within the banks, you'll have the corporate advisory team. You can work with them, and they'll work with their clients to try and incorporate a biodiversity credit in the corporate transition program. Or you could also work with the DCM, debt capital markets investment team, where you'll have entire teams who are fully dedicated. And I speak to a couple of banks who have entire research teams dedicated to these sort of instruments. Impact VC funds are also very good partners, and also co-investment partners can help bring these things off the ground. These profiles are more, often able to take upfront risk. They understand that money needs to be locked in for a longer period of time, and that the early stages of an enterprise might take a little while to offtake, and so the level of risk that they're able to take in is higher, typically, with higher gains, higher stakes. What not to underestimate next is obviously making sure that the capital market infrastructure is helpful and supportive. So I've mentioned stock exchanges and indices, so index providers, rating agencies. You do want to engage and develop a relationship with rating agencies so that there's always going to be a portion of the market that's non-rated, but I would recommend that biodiversity credits be treated like any other instrument and receive a rating, because again, you make them instantaneously more usable by an investor, a portfolio manager. And I can go into the reasons for this, but generally it's helpful. Vendors, because if you have a trader in front of his Bloomberg screen all day, if you have a bond or a biodiversity credit that's been flagged as eligible, immediately, it comes through a feed, it becomes visible to the right target audience, and that's helpful. And obviously, regulatory oversight falls under that category, I suppose. And then the investor, there are loads of different investor segments, and they all have different levels of risk profile. We've touched on some investors that come earlier in the food chain, like impact VC funds. But if you think of your more traditional institutionalized investors, you're thinking of your traditional asset managers, asset owners, which can be pension funds or insurance companies. You can have private banks, wealth managers, and then smaller family offices also who can invest directly sometimes. But all that, I think it's really important to understand the different stakeholders, because this is about engaging with different parties to develop maximum buy-in from a maximum number of people as we go along on this journey. So corporate sustainable finance. So typically a corporate who's engaging in a transition. So they've committed to get themselves on a trajectory to net zero by 2030, and they may have residual emissions of their balance sheet, which in the phase out process, and by the way, when I say corporates, it can be financial corporates or non-financial corporates. So a bank would also have to look at their own operations and finance operations, as in the sort of business that washes through the bank. And so these are the typical strategies for shifting finance away from negative impact towards positive outcomes. So it's this phasing out of bad of key negative activities. They will also want to reduce the drivers of loss. They will want to generate biodiversity gains, which I think they come at different points on this. And then the fourth one is that they want to support system scale changes across their operations. And so for me, the way I look at it is that, through all these different activities that they in their effort to shift, there's an opportunity to position biodiversity credits as a financial tool. And we would do this by engaging and leading stewardship with the CFO, with the chief financial officers, the corporate sustainability officers at the corporates, in order to help them achieve that high integrity transition that they're after. So this typically works under the guidance of the CSRD, which is the Regulatory Disclosure Program. It was supposed to start in January 25, but we all know what happened, and it's now being delayed by 2 years, unfortunately. It was the CSRD was on a very good trajectory until this year. On the investor side, there are different reasons why an investor may want to use biodiversity credit. I mean, certainly they can be viewed as a way to invest directly in projects that enhance and restore biodiversity, of course. It can be a way of diversifying their exposure in the portfolio and diversifying the returns, reducing the reliance on other traditional asset classes that may not be as well performing from a sustainability perspective. It could be about meeting their ESG goals. Now, ESG, I know there's been a lot of confusion. I think it's very important to understand that ESG is different from label debt markets, so if you were to create a label for a biodiversity credit, it's a completely different lens than ESG. ESG has been used extensively and erroneously. ESG is about integrating some risk factors into the evaluation process in the process of investing. So this can be done with bonds that are conventional and absolutely not labeled as green, social, and sustainable. It can be done with just a traditional bond, a corporate coming to market to finance through debt, and you just put an ESG lens on it to assess the risk from an environmental, social, and governance perspective. And then you score it, and then it will maybe move the valuation one way or another, and then the analyst can look at that new valuation against how the bond is priced in the market and decide whether it's well priced, or whether actually there's more risk in that bond that the market has priced, and really looking for market inefficiencies to tap into and generate alpha. That's the story. Now, label biodiversity credit, I would imagine, would really sit better in a portfolio that's already fully committed to what we call an SFDR 9, which I'm going to go into in a minute, but that's the Sustainable Finance Disclosure Regulation, and the type of fund that essentially only invests in bonds, equities, and loans, and other instruments that are fully dedicated, where the use of proceeds is fully dedicated to social, environmental, and sustainable targets and objectives, assets, activities. Biodiversity. So it's also about obviously addressing biodiversity risk in the portfolios. It can also be about meeting some compliance. So there might be some regulatory requirements internationally set, or it can be domestically set. And then supporting biodiversity conservation. So that's obviously another reason why an asset manager may want to engage in with those instruments. In my personal opinion, I don't know. None of this is verified or actually happening, as far as I know. Not a lot, not by traditional asset managers yet. But that's why it's an opportunity. And so when an investor looks to invest, let's imagine the optimal scenario where you have a pension fund who commissions and mandates an asset manager to invest in a particular strategy. They will dictate some investment guidelines, and it will be at least a fixed income portfolio, debt portfolio. There will be requirements around the level of yield, the level of duration, which is that exposure to movement in interest rates, volatility. It will want to focus on specific sectors. It could be as broad or as narrow as possible, as you like, regionally or sectorally. They could, in the future, God knows, actually manage against bioregions. That's something that I was proposing, starting to think of the market as living systems and investing, having benchmarks that reflect bioregions rather than by Asia and steel. And so at the moment the benchmark are it's a certain taxonomy that basically dictates what goes into a portfolio. So you're going to have some emerging market bond benchmark. Anything that's frontier is never going to make it into the emerging market. So it's a completely different. The segregation and inclusion and exclusion of certain types of assets is completely economically driven and geographically driven. And there is a case, in my opinion, to really review this. And if you were to look at, bioregion as a better way of benchmarking for risk, for climate risk, that's something that I think is fascinating to look at. So you would really want to frame some clear investor terms along the side. So, and I put ... because obviously we'd need and want to be to put a lot of thought into and better about that side of things, like what is it that you want to measure, what are the best measures for biodiversity credits to appeal. And it doesn't have to be a lot. If you think of a sustainability linked bond, you set targets, and then the coupon is essentially, it might be, you might reward the issuer if they meet the target, or you might penalize them if they miss the target. And it could be, so therefore they get a reduction in borrowing costs by 25 basis points if they meet the target, and they get an increase in the borrowing costs if they fail. So it's, it doesn't have to be a lot, but it needs to be something that the market are going to hold on to and use as a way of pricing and understanding the risks and return of that particular instrument. And as I was mentioning earlier, so a pension fund is going to want these particular characteristics to feature into the investment guidelines. And then this, from a regulatory perspective, is governed by the SFDR, Sustainable Finance Disclosure Regulation. And as I mentioned, obviously, so there is Article 6, which is purely ESG, Article 8, where you have an ESG objective for the fund, but you can go about it different ways, as in you can include labeled debt and use of proceeds bonds. But the Article 9 is very much about only assets that are fully dedicated to environmental and social objectives, and avoiding significant harm and adhering to good governance. So with that, obviously, yes, am I running out of time? I'm
No,
coming to,
it's less that and more. I wonder if for this last one, if we could refer to it if questions come up. But a few questions have come
yes,
up in chat, and I want to make
oh,
sure there's
sorry.
time to
Yes,
digest because I feel like there's so much learning, and I feel like everyone's probably processing. So one of the questions that uh, Joel asked in chat is, could you rank, I think it was 2 or 3 slides back, where
yeah,
you had what investors were looking for, and asking if you could rank those uses in terms of what investors would choose first at this moment, or kind of um, among the must-haves or among the nice-to-haves. Are you seeing a certain trend or ranking
yeah.
among them?
Yeah, I think it's very wise. Thank you for the question. I think it's very wise to, if you want to build something like super solid and something that's not going to be, there are so many people out there looking to criticize and destroy the goodwill, that what you really want to create is something super robust, and therefore build the credibility. It has to be incredibly um incredibly credible anyway. It's like, or
Hmm.
whatever. But the verification aspect of things, and I appreciate certification can be another, because it's way more, but the verification is essentially a pre-screening of where the proceeds are used. So if I mean, and you would have to pick up from where I leave off here, because you have the technical knowledge. But if you were to issue that biodiversity credit, admittedly on the registry, I'm imagining visually you would be able to see all the different projects underneath, and you would be able, these are tagged and they will have been, sourced, and the sources are validated, and there have been a number of checks and verification. And I think so, that's why I have it as the first thing is, verification. This traceability is actually adding to that credibility, because it's also being able to see how things are progressing with time and how much improvement. Um, so I tend to feel that this is where civil society comes in, like, the NGOs, who, by the way, tend to be more neutral because they're given a grant and they're really just there to set a high standard, and they should be neutral. Sometimes they hire people like me, like the Climate Bonds Initiative would have, people from finance to try and, but it's more academics in, scientists inside, and they're there to really deliver something super solid and to set the standard as high as possible, set the bar as high as possible when they develop standards and develop criteria for each. Um, so when you set criteria, you set a threshold, and that means that, for everybody to know where to stand in terms of, in this case, the level of positive impact, that you're delivering. So what is the positive externality of this particular biodiversity credit? And you would be able to, well, one, express it, verify it so that it screens well, and then and be able to check it through a third party verifier. So what we call secondary party opinions. This is why rating agencies are also important, you see, because they come in and they become verifiers. I'm currently working on a secondary party opinion for a Japanese corporate, trying to embed gender lens in their investment framework. And that's exactly, trying to meet principles, can be and demonstrate that you're meeting principles. And if you're not meeting principles now, you're developing either some R&D, so research and development, to get there, or deploying capital to get there. But in any way, yeah, there is expenditure being made towards improving. I mean, size is important because, size is also liquidity. But as a starting point, and that's where I think that Regen, the registry, is helpful, is that it provides this verification element and reporting.
So there's a question, Efrain, you ask a great question that Howard backs up. Instead of me reading it, would you like to share your question? No, you aren't muted from where we can see, but we can't hear you. Nope.
There's a lag.
It seems like it. Well, I'll start and then you can kind of follow up.
Can you hear me now?
Yes, perfect.
Yes.
Yeah, go for it.
Okay, so basically it's for a farmer that is restoring already degraded land through agroforestry or regenerative ranching.
Yeah.
And at this point, that meaning it's already boosting soil carbon and most likely biodiversity as well. What is the advantage on issuing a standalone biodiversity credit? I'm just reading how I wrote it. When high integrity carbon credits can already embed verified ecological and social co-benefits. And the question is, wouldn't it be more practical to tap the existing voluntary carbon market infrastructure and liquidity to create this single rigorously measured eco credit that can already transparently bundle carbon removals, biodiversity gains, and community impact? And just really quick, I asked this because the question is like, if a farmer is already doing this, would we recommend, like as a consultant for generating this type of commodities for farmers, would we recommend them to use a methodology like ecometrics or part of Regen Network in order to increase soil organic carbon, that it's already a market that has value? And can we already, like on top of that, generate more value by tracking biodiversity and do that, or put it as part of a co-benefit for the carbon credit? How can we, why would we recommend otherwise to the farmer to use a biodiversity methodology if the market is already so uncertain and so on? And also, it's already so complicated to already differentiate in the carbon removals, high integrity, nature-based, so many methodologies, and how they're offering different levels of certainty and transparency, that it almost seems like more layers of complexity to add another market and so on. Like, wouldn't it be a better idea to develop an already existing market into making it better or better quality?
I have thoughts on this, but I'm wondering if I think either Becca or David Wright might be in a better position to answer this, but I don't want to pick on David if he's busy doing something, because he's not on screen.
Yeah, I'm here. Sorry, just switching stuff back on. Can you hear me? I was just typing a reply actually in message. It's a really good question. All I can contribute to it is we've had multiple conversations with buyers, so discussing the purchase of our carbon credits, originated by the ecometric methodology. and credit class on the Regen Network, who have asked for quantifiable biodiversity co-benefits. So they were willing to pay a premium price for the carbon credits if we could quantify the biodiversity. So we're actively trying to find partners who can scientifically quantify biodiversity, which is in itself a challenge, to realize that value. So we have seen increments of raising the credit value from approximately £35 per tonne, so $45, and almost doubling the value if we can quantify biodiversity. So the question a Frayne is asking, there is a market for. It doesn't mean there's not a separate biodiversity market, but I think they can be bundled with carbon. And I think, interestingly, the principle behind that is buyers often still feel slightly nervous of buying, but presentationally buying carbon as a commodity in isolation, and they like the idea of being seen to have a broader ESG ambition of including biodiversity and other nature benefits. It's more presentable from a PR perspective.
Yeah, I guess the question is going towards precisely that. Like, wouldn't it make more sense to continue developing the carbon market into this into adding these layers of biodiversity and social co-benefits, other than developing a whole new market? And like, otherwise, why would it make sense to develop a new market by itself, like a new biodiversity credit just by itself?
So in my opinion, from a market infrastructure perspective, would probably be channeled, through a single platform. I don't think from the financial ecosystem perspective, you need a separate ecosystem. I think that biodiversity credits and VCM markets and regulatory, they can all operate. And this is why I thought it was interesting. We can share more widely, what the London Stock Exchange has proposed. And I don't know how far they've gone, but they did this in 2022, so that was 3 years ago. I've been asking for an update actually, but I've not heard. Yeah, I don't from the finance perspective, there does not need to be much of a differentiation in how they're processed. But from the farmer's perspective, I think that yes, there would be differentiation. That's where the differentiation would reside.
I think there's something when it comes to like where in the world and what's happening in a specific place in an ecosystem. And for many places, carbon crediting does not make sense for various reasons. If you're in a semi-arid or arid landscape, your carbon gains are not going to be sufficient enough to make it worthwhile. Or perhaps you're in a more like vulnerable situation. You have communities that there would be so much to logistically and financially and contractually figure out within a carbon market scenario that a biodiversity approach makes more sense. Like potentially less, predatory actors. Like there's just a little more flexibility and room. That's certainly been our experience so far on both ends of the spectrum. I do agree in that there should be. It's very much a regen style to say, well, there are going to be there should be a proliferation of options that a community or an organization or set of farms can explore what makes the most sense for them, and even potentially use biodiversity crediting as an on-ramp to carbon, to start to learn more about what potential carbon gains there might be. But it is complicated. I'm excited by the different opportunities to bundle and mix. And I think something that Constance, that you had shared, was really a call for integrating investors and buyers early in the development of projects and methodologies, so that all of the effort that's being gone to is deeply informed by the buy side and by the supply side.
Yeah. Honestly, I can shall we go through other questions or?
Yeah, I'd love to, for others, there are some questions rolling in chat, but if folks want to raise hands and we can kind of move around, it'd be great to spend our last chunk of time sharing, perspectives, use cases, questions. Yeah, Howard, go for it.
Hey, well, thank you. I certainly appreciated the presentation, and I wanted to build on the prior discussion and turn attention to microbiodiversity and to apply that concept not just to charismatic megafauna, which are certainly a way to get attention and create the perception of value. But I'm wondering how your experience in the markets, particularly markets occupied by corporates in the food and fiber space, how much value can we attach to biodiversity as a measure of climate resilience, and particularly to emphasize soil as the measure of success rather than counting creatures and getting as large a biodiversity measure there. I'm just sort of curious about turning the telescope into a microscope and looking at eco credits for carbon plus biodiversity in the context of the soil microbiome as being where the diversity is most highly valued.
I think that's a brilliant topic, but I'm not sure I'm the best place. If we can open the floor.
Yeah, well, I wonder, Constance, for a developer that's new to this space or that's struggling to bring supply to the buyer market, what does it look like to try to seek investment and to try to engage in those kind of relationships and like a dialogue to where there's kind of more understanding or more kind of a co-building. What might that look like?
So the best bet is to try and spend time in forums where people are already bought into the concept of because the recent blowback on ESG, DEI, biodiversity, or more broadly regulation, any regulation that's considered woke, has meant that engaging with some people have decided to do better on the ground where they stand, and that's fantastic. I mean, people who are fully committed to impact investing, or even traditional asset managers who haven't shut down their ESG fund proposition. I'm thinking of a traditional asset manager like the Federated Hermes. They had a nature fund that they shut down at the end of last year completely, and just laid the team off. Like, it was quite brutal. But then other managers, and so it's quite interesting because I think that the trend has been that in public markets, there's been a rollback, but the financing gap that's been left in the public markets and from on the social side, from the USAID freeze, so development type of concessionary money, the private sector money has decided to step in. And I think this is where I'm hopeful, because in my work, I collaborate with a number of private credit and private capital small shops, and there's no way they're going to meet ever the sort of the level of financing that we used to receive from USAID, or that larger investors used to provide. But private capital money is very powerful, and if you manage to engage with people who see the value of the IPCC, all the valid reports that are out there, and demonstrating the need for a massive shift in how we invest, then it gets much easier. So what I would recommend is engage in spaces like the Global Impact Investment Network. There are loads of forums that are fully dedicated to people who are committed to it and not prepared to compromise on these topics. And that's been the best bet, frankly, in terms of advancing certain topics and collaborating and rolling out funding for a number of things. Because as I mentioned earlier, concessionary money is very catalytic. So the blending of private and public capital can really help getting projects underway. So it's a shame that recently some of that concessionary funding has gone. But like I said, I have hope that private sector money and philanthropy have decided to step in.
Constance, can I direct your attention to the insurance pools? And I
Yeah.
think one of these mega trends is that corporations are going to have to self-insure their
Yes.
supply chains against business interruption.
Yes.
And for me, that would be such a synergistic place to take this proposition of biodiversity and climate resilience to create a product that will have the appropriate horizons for insurance and reinsurance, and to treat some of these eco credits as risk management tools, both reputational, but more importantly, supply chain. And that's a pet idea would like to run past you in looking at focusing that niche, because it's long-term investments, which are kind of hard to find in a lot of financial markets. And they have the dual benefit of, at least at some degree, managing risks they've already exposed to, while having a financial instrument that is virtuous and consistent with their business interest.
Yeah, insurance is a pain point, and I think that they were very late to the game relative to the level of knowledge that they have. So they harvest data like nobody, and yet they were very slow at putting it to good use for this type of matters. And so, but there's a big shift. AXA and Aviva in Europe are pretty big. Howden are making, very big moves. So there is hope that increasingly there are going to be more instruments coming to market from the insurance perspective. Yes. Hand up.
Just one quick comment to close. That whole concept can also be used in corporate finance to self-insure through this type of instrument.
Yes, and corporates absolutely might want to start doing that as part of their phase-out strategy and overall transition of their balance sheets. But that will impact valuations big time. This is where we're going to start feeling the pain for real.
Thank you.
Thank you.
Like Ed has a question. Ed, for it.
Yeah, thanks for having me on. I come from regenerative ag movement, and what we've been seeing recently is a real interest from many CEOs to really understand all the benefits and what regenerative ag and land stewardship is really all about, and all that it touches, because we're starting to realize so many more benefits. Even in the biodiversity, is sort of Howard mentioned, the soil biodiversity is now being shown to be the #1 factor in metabolomics, which is the nutrient density of food and spectrum. And of course, that's bringing great attention to the medical community, which then ties in with the food community. So it's bringing a lot more players to the table to realize, because most of these natural resource systems never took into account externalities. And yet, we have to deal with these, from the health of us to our planet to our waterways, our air, all these things together. And what regenerative farmer leaders, when they're talking to these people, are saying is, you can't put all the responsibility and much of the cost and the risks on just the farmers. It needs to be taken up across the supply chain and with all the players that have impact or involvement in all these areas. So I think what's happening is these, especially at the CEO level, they're starting to kind of paint a picture now of a system that brings this all together. And then how does the whole supply chain have a role in this, and both financing and to, again, take away from the initial focus that had just been on the farmers or the land stewards, as I said, taking up much of the cost, the risks, and the responsibilities. So I don't know if you're seeing that from talking to CEOs around and what their interests are, because we have our farmers from the US now traveling across the world, being asked to give presentations to both governments, NGOs, but especially CEOs. So I'll land it there.
Yeah, thank you. Me personally, my experience directly with CEOs is limited, because the last particular assignment that I was trying to reach out to corporates was for an NGO called the Climate Bonds Initiative. And frankly, if you want to reach as many people as possible, you best working with the banks, because they have corporate advisory teams and they can push out. Now, the banks are not going to necessarily, pitch this to every client. They will figure out what their client wants. And if their client is open to having those conversations, then they will engage and push some ideas. But so talking to, for example, Rabobank, who have a big sustainability program, and their food division, they have Tesco and Coca-Cola and all these. Tesco is like a food distribution. It's like a supermarket in the UK, and they engage quite deeply. And this is where the green bonds market, is quite effective, because you're demanding those corporates to come to market with projects to finance that drill down the use of proceeds. Has to be incredibly transparent. So this is where you would want to insert your biodiversity. Essentially, you would have different use of proceeds, and at the time of screening those bonds. And I feel terrible telling you this, because this is so far away from everything that's so beautiful that you've just described about creating this biodiversity and the microbiome of the soil. But essentially, if you take the corporate lens, this is how it comes down to it. If they want to raise finance through the debt market, they're going to structure a bond by already allocating to different projects, and those projects might impact different sectors. and then the bond gets screened, and then some process of verification at some point down the line determines whether the overall bond is eligible for a label. And if that bond, I'm sorry, it's just like feels so painful because I wish things were so much more obvious, but it's a journey. And I think, if I tell you exactly, this is the process, this is how a corporate can incorporate biodiversity gains into their strategy. And admittedly, this should be really helpful, as I explained earlier, to progress, advance their strategy, meet target assessments, and then eventually, if we had, mass movement into this space, should also improve the cost of borrowing for them, i.e. reduce it. Because if they become more regenerative, they decrease risk, they decrease they become innovative towards this de-risking of the return on investment, and therefore they should price better in the market, right? Because essentially they're more attractive, their credit worthiness goes up. So all these things should make sense to market participants and ultimately investors, who see from their perspective, well, the return of that bond is attractive and is only going to improve because clearly that corporate is committed to improving, reducing the risk, improving the odds of generating biodiversity gains. So therefore it should price better. This is what we all dream of when we work for an NGO that focuses on climate finance. That's the dream, and the market grows bigger and more finance becomes is channeled into those projects. But unfortunately, the headwinds, it has, $6 trillion in green bonds, in labeled debt, so it's green, social, sustainable. It's the whole package. Is okay, it's a lot, and it's not a lot. It's a lot compared to having started from the $5 million that you mentioned earlier, but it's also only a fraction, because public debt nowadays is like 300 trillion, right? It's completely ballooned globally. So we're really scratching the surface, and this is why you see in those finance professionals who've decided, who've kind of like wanted to, be either ESG or in green debt or sustainable equities, or the frustration, because we know the numbers and it just doesn't, we're not really making any difference at this point. And then the rollback comes over as if, and then all that money that was supposed to be dedicated to this is now spent on war. Anyway, so yeah, I feel the pain. Sorry. Shayla, we're closing, aren't we?
Yes, we are. I just have a very quick one. A lot of people on this call are also smallholders, and a lot of these things just don't really the global frameworks don't fit into these financial frameworks. And I'm just very curious. Thank you, first of all, for your presentation. It's been amazing. But I'm just really curious about these alternative methods for participatory decentralized verification, for instance, which would be more in my scene here in Kenya, for instance. And often what you see is that these methods, when they exist, they tend to compromise the neutrality or credibility of the credits from a corporate perspective. And I'm wondering, what is it going to take for these global financial frameworks to start accepting them, or what do we need to do to legitimize these frameworks for the capital markets?
I think it's not for lack of effort. I mean, you see the people showing up at COP15 at the, it's really something. The biodiversity COPs are, incredibly, the one in Brazil most recent one was incredibly busy, way busier than COP29. So it's not like, you know, there are people who are focusing on this. And yes, I've tried to represent on this slide, you know, the different attempts, but you do need, for example, the UNFCCC Article 6 is not being adopted but universally, you know, across the globe at the moment. So there are still countries who are, you know, refusing to come to terms with the fact that there is a net zero target, and they need to commit to the nationally defined contribution targets. So that's an issue, because governments need to step in order to then, you know, create that leadership, so that corporates then, you know, the domestic corporates get on board. So that's one thing. And then I've listed, you know, here all the accounting and reporting standards. I think ISSB is definitely making progress. I have good faith that they, you know, they have excellent people there who have incredible drive. Emmanuel Faber was CEO of Danone in the past, and so you know, he's driving that effort. And you know, hopefully, you know, these things are going to make progress. And you've mentioned the TNFD earlier. Those financial disclosures around nature are important. Setting standards generally for labeling is important. So setting criteria, as I said earlier, with thresholds to meet on the corporate's balance sheets, in the investors' investment portfolios, and at the level of the biocredit itself, to know, so that we have an even keel and we can compare apple with apple. I've had very good, there's incredible representation of this. I wasn't aware of it, but came across this lady who's leading the core carbon principles, which is, and this is part of an integrity council. So I appreciate that it's different, but I think that these things are very hopeful. There are some, the ITMOs on the more DeFi side of things are also going to be helpful to set standards in terms of, you know, units, tradability of the units. And yes, this idea that we need a universal advanced digital registry is also something that's being pushed by something called the Climate Action Center of Excellence, that's been launched by the United Nations, and has been working on these topics and DeFi and as an interoperability tool. So, I mean, I left it at that, the presentation, because, you know, I realized that it's really weird. I was telling Becca how, you know, you put a presentation like this together and you feel like you were scratching the surface at the same time going into too much detail, because it's really sprawling. And I can tell that you as well as an audience have your own questions but I think that that's the point of the exercise today, was to get people in the same room and have conversations. And the questions that you've asked today will stay with me, definitely, with the work that I do. And I hope that what I shared with you today will also give you some perspective of how things are being thought about in the financial ecosystem. And
yeah, I just feel extremely grateful for your time, Constance, and the thought and care that you have, you know, coming into a space of folks that are from all over the world doing all manner of things, and really ultimately trying to fund those things. And I have certainly learned a lot, you know, not coming from the financial space at all. I The word position comes to my mind as kind of like everyone's trying to position themselves in the larger space, and then all the way down to where they position their own work and try to seek what opportunities they can. we'll be sharing out links, and I'll probably glean some more from you, Constance, to share. Shared a lot in the chat as well. So folks want to take a minute before we close to grab anything that's relevant there. We have a lot moving over these next couple of weeks at Regen, specifically related to biodiversity crediting. There's a webinar series that I've left in chat around the biodiversity stewardship protocol and kind of market making there. But Constance, I feel like you remind us that this is I feel like aware of how diverse and sprawling the supply side is, but it's nice to hear that, that's the same thing on the investment and financial side, and we all kind of need to continually come together and find those connection points. So thank you very much.
Yeah, just to echo Becca's sentiment, I think this was like incredibly rigorous and really razor sharp in speaking the language of an entire ecosystem that many different stakeholders are trying to connect and bushwhack a common understanding through. And this was just like a deep download that I feel incredibly thankful for you sharing. So sincere gratitude.
Thank you.
And this will be available, so if folks want to sift back through it, and as I probably will, we'll make that available on the YouTube. But thank you all. Have a great rest of your day and week. Take care. See you next time.
Thank you.
Bye all.